Welcome to the second in our series of options primers. In this presentation, we will discuss some basic strategies. This primer will cover the following topics: buying and selling options. First, we will focus on calls. We'll look at the buyer's perspective as well as the seller's perspective. We will then discuss puts from both the buyer's and seller's perspective. We will finish with several examples. When an investor buys a call, they are buying the right to buy a stock or index at the strike price within a given period of time. This is similar to a rain check where someone can lock in a price. The only difference is the rain check is being purchased at a price. When purchasing a put, the buyer obtains the right to sell a stock or index at the strike price within a given period of time. When dealing with equity options, which represent an individual stock, the available strike prices are relative to the price of the stock. Strike prices start at $5 and increment by $2.50 up to approximately $50. Here the prices increment by $5 until approximately $100, at which point they increment by $10. Index options are slightly different. Index stocks represent an entire group of related stocks. Their corresponding options have strike prices that increment by $1. This allows more flexibility in trading strategy. Now, let's look at the call. The call option involves two parties, the call buyer and the call seller. The call buyer is considered long the call option. The call buyer pays a premium to the seller to enter the contract. This premium will depend on several factors, including the stock, the strike price, and time until expiration. Once the buyer purchases the option, he controls what happens next. He can either exercise the option, which means buy the stock at the strike price, or allow it to expire. The call seller is considered short the call option. She receives the premium from the buyer to enter the contract. At this point, the seller is at the whim of the buyer. If the buyer chooses to exercise, she must deliver 100 shares at the strike price. If he decides not to exercise, she has no further obligation. In either case, she keeps the premium received to enter the contract. So why would someone buy a call? There are several reasons, but here are a few. First, the investor is bullish on the underlying stock. The call allows the buyer to lower the amount of risk associated with his investment. The call also allows the buyer to leverage a larger amount of money. If the call buyer is correct, he can exercise the option, thus buying the stock or index at the strike price. This would make him long the stock or index. The buyer could also sell the option for a profit. If the buyer is incorrect, he loses 100% of his investment. So what about the seller? Why sell an option? Well, the investor is either neutral or bearish on the stock or index, feeling it will decline in value. Also, the seller receives cash immediately for selling the option. If the seller is correct, she will retain the entire premium. If the seller was incorrect, she must deliver the underlying to the buyer at the corresponding strike price. If the seller is covered, which means she already owns the stock or index, she'll simply hand over the stock. However, if she was naked, meaning she didn't own the underlying stock or index, she must purchase the underlying at the current market price and deliver to the buyer at the strike price. Since this involves unlimited risk, most brokerages don't allow naked calls unless the investor meets strict guidelines. Now let's look at buying a put. Again, the process involves two parties, the put buyer and the put seller. The put buyer is long the put option. He pays the premium to the seller and controls what happens next. He can either exercise the option, selling the underlying at the strike price, or allow the option to expire. The put seller is short the put option. She receives a premium from the buyer. She must fulfill the contract if the buyer decides to exercise. So why buy a put? There are several reasons. One, the investor may be bearish on the underlying. A trader buys the put instead of shorting the underlying, thus reducing their risk. As an alternative, the put can be paired with the underlying to provide insurance in case the underlying falls in value. If the put buyer is correct, he can exercise the option, selling the long position on the stock or index at the strike price, or they can sell the option for a profit. If the buyer is incorrect, he loses 100% of the investment. So why sell a put? The put seller is either neutral or bullish on the underlying stock or index. She receives a premium and can use the cash immediately. If she is correct, she retains all of the premiums. If she is incorrect, she must purchase the underlying from the buyer at the strike price. Now let's look at our first of three examples. We'll use IBM as our example underlying stock. Investor 1 is bullish on IBM stock, currently trading at $126 per share. She feels it will rise to $140 by the end of the year. She could purchase 100 shares of the stock, but the investor doesn't want to tie up this amount of money. So she pays $940 for one call option that expires in January 2009 with a strike price of $125. This is much less than the $12,600 she would have paid to own the stock. However, she doesn't break even until the stock is at $134.40, which is the strike price of $125 plus the premium paid. Investor 2 is neutral on IBM and feels it'll remain flat. He sells one call to Investor 1 and receives $940. If IBM rises in value, Investor 1 may decide to exercise her call, allowing her to purchase IBM for $125. If this occurs, Investor 2 must deliver 100 shares to Investor 1 for $125. If Investor 2 is covered and owns IBM stock, he can simply give her the stock from his portfolio. If Investor 2 is naked IBM stock, he'll have to purchase 100 shares of IBM stock at the market price, regardless of the price, and sell them to Investor 1 for $125. This could result in significant losses. For instance, if Investor 1 was correct and IBM was trading at $140, Investor 2 would have to purchase the stock at $140 and turn right around and sell to Investor 1 at $125. Now let's look at what happens if Investor 2 was right. If IBM falls, Investor 2 keeps the entire premium. If Investor 2 actually owns IBM stock, this premium can offset some of the losses. Also, Investor 2 could repeat the process, collecting more premium. Let's look at another example. Let's say Investor 1 is bearish on IBM, trading at $126. She feels it's overpriced and will fall to $110 by the end of the year. She doesn't want to short IBM. She purchases one January 2009 put with a strike price of $125 for $790. Her break-even is $117.10, which is the strike price of $125 minus the premium. Investor 2 is bullish on IBM and feels $125 is a fair price. He sells one put to Investor 1 and receives $790. If IBM falls, Investor 2 will be required to purchase 100 shares of IBM at $125 from Investor 1, regardless of the current market price. However, this technique can be used as a method for discounting the stock. Remember, when the deal was entered, IBM was trading at $126. If the option is exercised, Investor 2 would actually be buying the stock at $117.10, which is $125 strike price minus $7.90. This is a 6% discount. If IBM rises, Investor 2 keeps the premium. Investor 2 could repeat this process. For our third example, let's look at an investor who already owns IBM stock. She is concerned IBM may fall in value. Therefore, she pays $790 to purchase a January 2009 put with a $125 strike. This put allows her to sell her stock for $125 no matter how far IBM falls. Therefore, this acts as a form of insurance on her stock. However, assuming she bought IBM at $126, she doesn't make a profit until IBM reaches $133.90, $126 plus $7.90.